Hi guys, me again. So this is class 24. We're still in chapter 14. We're continuing with our discussion of section 162, specifically as it pertains to travel expenses. Now, I think we left off with the problems on page 375. So problem number 1, commuter owns a home in suburb of city and drives to work in city every day. He eats lunch in various restaurants in city. May commuter deduct his cost of transportation and/or meals? Well, answer no. This is a commuting expense. It's considered personal and not required by the exigencies of the business. Now, you may say, what? How can that be? So going to work each day and back, isn't that a work expense? The answer is no, it is not, because it's your personal decision where you choose to live and how far away that is from your principal place of business. This also means that you cannot deduct parking fees either while you're at work. I'll mention a case to you that's an exception to that rule, and the case is Polii versus Commissioner at 877 F. 2nd, 838. This is a 10th Circuit decision from 1989. Now, Polii was a police captain who was required to be on duty 24 hours a day. Therefore, he was allowed to deduct his commuting expenses in going from his residence to a temporary location or to the police station and back. This is a very narrow exception, though. In B, same as A, but now commuter is a self-employed attorney, often must travel between his office and the city courthouse to file papers, try cases, etc. May commuter deduct all or any of his costs of transportation and meals? Well, commuter may deduct the transportation costs of going from his office to the courthouse and back. This also applies if your employer has two separate business locations and you go from one location to another. And it's deductible whether it's just you or whether you have two separate employers. You can deduct expenses incurred in going between employers. This also applies if you're self-employed. So if you have your own firm, you still get to deduct your transportation expenses in going from your office to the courthouse and back. Of course, no expenses can be deductible in going from your home to your office and back. The standard IRS mileage rate for business travel for 2019 is 58 cents a mile. That has gone down a half a cent for 2020, so it's now 57.5 cents per mile. Meals are not deductible in this case. I'll come back to that in just a second. In C, commuter resides and works in city, but occasionally must fly to other city on business. He eats lunch in another city and returns home in the late afternoon or early evening. May he deduct all or part of his costs? So remember, I said that we must separate these various travel expenses out into individual items because they may be treated differently for tax purposes. Well, in this problem, commuter is flying from city to other city on business. Therefore, he may deduct his transportation expenses. These include his mileage rate from the office to the airport and back, his parking fees at the airport, the cost of his plane ticket, plus any cab or Uber expenses that he incurs. Now, what about his meals while he's there? Well, the Supreme Court said in the Correll case, which is cited in the Rosenspan case on page 359, meals are deductible if you are away from home in a situation that requires sleep or rest. Since commuter's only gone for the day, no deduction for his lunch. Problem 2. Taxpayer lives with her husband and children in city and works there. A, if she works in Metro on business for 2 days and 1 night each week, what may she deduct? Well, taxpayer's tax home would be considered city. So when she's in Metro on business, she's away from home. So she has one business in 2 locations. Under Revenue Ruling 99-7, she may deduct the costs of going between those businesses. She may deduct her transportation expenses, lodging in Metro, and 50% of the cost of her meals while she's in Metro. Now, this is under Section 274N, which says that the deduction for meals is limited to 50% of the cost of those meals. If this is a temporary business location, she could deduct the cost of commuting from her home in city to Metro. If it's a permanent location, she cannot deduct the costs of going from her home in city to Metro or from Metro to her home. But if she goes from the office in city to Metro or from Metro to her city office, that cost is deductible. In B, same as A, except she works 3 days and spends 2 nights each week in Metro and maintains an apartment there. So now, meal and lodging expenses must be subject to the Flowers test. So, first of all, they must be incurred while away from home. Second, they must be required by the exigencies of the business. And third, they must pass the Comm'r test, so they must be incident to necessary sleep or rest. Now, the question arises here of where is her tax home, and what tests do we apply to determine that? The IRS, the tax court, and some circuit courts use the principal place of business test, while the Second Circuit in Rosenspan and some other circuit courts apply the principal place of residence test. So under the principal place of residence test, her tax home would be city because her family lives there and she spends most of her time there. Under the principal place of business test, we would look to where she engages in the greater portion of her business activities and derives the greater portion of her income. That looks like Metro. But in close cases, we also look to things like where her family lives and where she intends to have her principal residence. If that is city, then her transportation costs, 50% of the cost of her meals, and the cost of her apartment, including utilities, etc., while she's in Metro, would be deductible. In C, taxpayer and husband own a home in city, and husband works there. Taxpayer works in Metro, maintaining an apartment there, and travels to city each weekend to visit her husband and family. What may she deduct? Under the Carver and Foote cases, taxpayer and her husband are considered two separate taxpayers with two separate businesses and different tax homes for purposes of Section 162A2. Taxpayer's tax home is in Metro, so her meals and lodging while she's there are not deductible because she's not away from home. Her trips back to city to see her family are non-deductible personal expenses. Now let's look to the hearth as home or principal place of residence test. Although taxpayer might be away from home while she's in Metro, her expenses are not due to the exigencies of her business, but instead to her personal decision to live in city. So no deduction while she's traveling to or in city. In 3A, Burley is a professional football player for the City Stompers. He and his wife own a home in Metro where they reside during the 7-month off season. If Burley's only source of income is his salary from the Stompers, may Burley deduct any of his city living expenses which he incurs during the football season? Well, Metro would not qualify as Burley's tax home because he engages in no business activity there. His principal place of business, and therefore his tax home, would be city, the location of the Stompers franchise. So Burley is not away from home when he incurs meal and lodging expenses in city during the football season, and thus no deduction while he's there. He also cannot deduct his living expenses in Metro because he does not incur those expenses in pursuit of a trade or business. So therefore he would flunk the Flowers test. In B, would it make any difference in result in A if during the 7-month off season, Burley owned an insurance agency in Metro and worked there? Well, yes, it might make a difference because this looks like the Andrews situation. Now Burley has 2 business locations, so we must determine which one is his tax home. Usually, the service looks to the amount of income earned at each location, and it considers that the most important consideration. The Sixth Circuit, though, and some other courts, look to the length of time spent at each location, and they consider that the most important factor. Here, Burley spends most of his time in Metro, and he maintains a principal residence there, so that appears to be his tax home. However, if his income from the city stompers is far greater than his income from the insurance agency, this might be a closer call. If his principal place of business is Metro, he may deduct 50% of the cost of his meals and the total cost of his lodging while he is in city. But if his tax home is city, and he does not maintain his city apartment during the stomper's off-season, there is some authority for disallowing in full the amount of the deduction for his living expenses, since he will have incurred no duplicate expenses. This is the position of both the Ninth Circuit and the tax court. Whether duplicate expenses are required or not may depend on the definition of home under 162A2. If principal place of residence is used, duplicate expenses are likely to be required, whereas less likely, although not entirely clear, if the principal place of business test is used. In 4, a consultant operates a management consulting business in city where consultant and his family live. Consultant has a client with troubles in another city in another state. The client asks consultant to perform services in another city for 9 months. Consultant's family stays in city, and he rents an apartment in another city, or consultant's expenses in other city deductible. Well, in the Purifoy case, cited in Andrews, the Supreme Court acknowledged that a deduction for transportation, meals, and lodging is allowed if the taxpayer is employed at a location away from home for a temporary rather than an indefinite period of time, and if the taxpayer retains ties with the old principal place of business. A definite time period of up to 1 year is considered temporary under 162A. Since the taxpayer here, consultant, has moved to other city for a definite 9-month period and will thereafter return to city, his employment is considered temporary, and his costs of transportation, lodging, and 50% of the cost of his meals will be deductible. The service has altered its prior position and now attempts to disallow the deduction of commuting expenses even when the taxpayer is away from home. Whether that's in accord with 162 remains to be seen. In B, what result in A? If the time period consultant is expected to be in another city is 9 months, but after 8 months, it is extended to 15 months. What then? When the time period that the taxpayer is to be gone is greater than a year, no deduction is allowed. That is not considered temporary. So it will be treated as though the taxpayer's tax home changed. But where the time period realistically is expected to be less than a year, but at some point it is extended to more than a year, the expenses are deductible up until the time period is extended. So here, consultant may deduct 8 months of expenses. Under Revenue Ruling 93-86, which is mentioned here, if the employment is reasonably expected to last and does last for a year or less, the employment is considered temporary as long as the facts and circumstances do not indicate otherwise. If the assignment is realistically expected to last more than a year, though, and there is not a reasonable expectation that it would be shorter, then the assignment is considered indefinite, regardless of whether or not it actually exceeds a year. So no deduction in that case. If the assignment is initially expected to last a year or less, but later is expected to last more than a year, which is our situation here, the employment is considered temporary until those expectations change, and then it will be considered indefinite thereafter. In C, what result in A? If consultant and his family had lived in a furnished apartment in city, and he and his family gave that apartment up and moved to other city where they lived in a furnished apartment for the 9 months. Well, what this question is getting at is whether 162 requires duplicate places of abode. If hearth is home, that is, if we're looking to the principal place of residence test, the taxpayer should own or maintain a continuing residence in an area from which she is away. If the tax home is principal place of business, it's questionable whether duplicate residences or significant contacts with the former location are required, although they have been present in all cases. The trend of recent cases seems to be to require duplicate expenses. Now, our next section, section 3, deals with necessary rental and similar payments. In the case of Starr's estate versus Commissioner, page 376. This case deals with the issue of when something is considered a sale and when it's considered a lease. In this case, Mr. Starr installed a sprinkler system in his plant. It was installed under a 5-year lease with annual rentals of $1,240. The lease agreement provided that at the end of the 5-year period, the lessee may renew for an additional 5 years at a rental of only $32 per year. If the lessee does not renew, the lessor will have 6 months to remove the system from the premises of the lessee. Now, first of all, why should the service even care whether this is a lease or a sale? Well, if this is a sale, then the cost of the system must be capitalized, that is, added to the basis of the building, and then depreciated over the useful life of the building. If it's a lease, then the rental payments may be deducted currently. If the building has a useful life of 39 to 40 years, then as a capital expense, only a very small portion of that payment could be deducted in a single year. As a lease, the cost of the system could be deducted out in 5 years. So the taxpayer here was trying to skew the timing of the tax benefit. The Ninth Circuit looked to substance over form. Thus, it would not take the parties at their word that this was a lease. Instead, it looked at the agreement to determine for itself whether in substance this was more of a sale or more of a lease. First, the agreement never passed title to the system to the lessee, so that made this look like a lease. Second, the court notes that most sprinkler systems have to be tailored to the individual building. It then becomes a fixture of the building, and if it has to be removed, it would damage both the building and the system, so that its salvageable value would be negligible. That makes it look more like a sale. Third, the lessor here had never reclaimed any other system from lessees who had met their agreed payments and was not likely to come after Starr's system either. That also looked like a sale. Fourth, the court decided that the nominal rental payments after the 5-year period were up was just a service charge for inspection of the system. So that also looked like a sale. Finally, the payments here seem to approximate the sales price of the system, plus interest, which also looks like a sale. So the court characterizes the lease as a sale. However, it admonishes the service for bringing this case because it notes that after Starr takes the depreciation and interest deductions, The difference between whether it's a sale or a lease for tax purposes may not be all that great. Note that under the Tax Cut and Jobs Act, beginning in 2018, under Section 163J, a business expense deduction is limited to business interest income plus 30% of the adjusted taxable income. Any excess deduction may be carried over until it's used up. As the text notes in the notes following Starr's estate, it used to be a popular tax avoidance strategy to structure a sale leaseback to a child in order to transfer money from a high bracket taxpayer to a lower bracket taxpayer. The service put the quietus on this, though, in the Tax Reform Act of 1986, which enacted what's called the kiddie tax. This provision taxes the unearned income of minors under the age of 19 or students under the age of 24 at their parents' rates. In addition, there were what were called Clifford trusts, in which interest from money in trust was transferred to children, and then the corpus of that trust reverted to the parent at the end of a 10-year period. So as long as the money was tied up for 10 years, it was a valid transfer system. This also was eliminated under the Tax Reform Act of 1986 with the grantor trust rules. Under these rules, the grantor of the trust is taxed if that grantor retains a reversionary interest of more than 5% in the trust. So these rules are no longer measured by a 10-year trust term, but instead by a greater than 5% interest in the trust. And that's a bit more subjective than a 10-year term. Now, Section D on page 381 deals with expenses for education. Under certain circumstances, expenses for education may be deductible under Section 162. Now, we mentioned that back when we were talking about fringe benefits under 132. I said we'd come back to this later, and here we are. As with all 162 deductions, however, the threshold requirements of Section 162 must be met first. So, these must be ordinary and necessary expenses incurred in carrying on a trade or business. Now, our first case is Hill versus Commissioner on page 382. Ms. Hill was the head of an English department at a high school in Danville, Virginia. In order to renew her special teaching certificate, the Virginia State Board of Education gave her two choices. She could A, acquire college credits, or B, pass an examination on 5 selected books. She chose alternative A and went to summer school at Columbia University in New York City. The Fourth Circuit notes that she undoubtedly chose the alternative that would most effectively add to her efficiency as a teacher. Now, Ms. Hill sought to deduct her expenses incurred while she was in New York City at Columbia, and these were denied by the service on the ground that they were not ordinary or necessary, because as the tax court in holding for the service stated, the record does not show that the course pursued by petitioner was the usual method followed by teachers in obtaining renewals of their certificates, or that it was necessary to do so. This is on page 384 in the flush language there. Therefore, the court said these are in the nature of personal expenses that may not be deducted. The Fourth Circuit, however, reversed the tax court, opining that it was unreasonable of the court to require a statistical showing by the taxpayer of the comparative number of Virginia teachers who elect for the renewal of their certificates the acquisition of college credits rather than the much less desirable alternative of standing an examination on the 5 selected books. It then went on to state at the top of page 385, if the particular course adopted by the taxpayer is a response that a reasonable person would ordinarily and naturally make under the specific circumstances, that would suffice. It also said in light of the slender salaries paid to teachers, many teachers would be deterred from pursuing the course chosen by Ms. Hill. Since Ms. Hill had been a teacher continuously for decades and was required to renew her certificate in order to continue in her present position, and this choice was given to her by the State Board of Education, her choice was therefore a reasonable one. According to the court, she went to Columbia to maintain her present position, not to attain a new position, to preserve, not to expand or increase, to carry on, not to commence. Therefore, the Fourth Circuit held that Ms. Hill's expenses were deductible. In Coughlin versus Commissioner on page 387, petitioner here was a tax attorney who attended the 5th Annual NYU Institute on Taxation. Now, note this is a 1953 case. To my knowledge, NYU still has these annual institutes on federal taxation. Mr. Coughlin traveled to New York, stayed in a hotel, and incurred not only lodging expenses, but also expenses for meals and tuition for the course. The Second Circuit held that these expenses were ordinary and necessary to his business. As an attorney, and especially as a tax attorney, he was morally bound to stay informed with the latest developments, and he did so by attending the NYU Institute. So this means that as an attorney, you may deduct your bar dues, subscriptions to professional journals, this includes online journals, and books, as well as subscriptions to Lexis and Westlaw, and the expenses of CLE, continuing legal education. What about the expenses of taking a bar review course? Well, those are not deductible because you're not carrying on a trade or business, but rather you're preparing to enter a business. So you're in a similar position to the Franks. Another problem, as we'll see later, is that those expenses qualify you for a new trade or business. So that would be considered a capital expenditure. Let's take a look at the problems on page 389. Problem number 1. Alice, Barbara, Kathy, and Denise were college roommates who, after graduating, went on to become a self-employed doctor, dentist, accountant as a CPA, and lawyer, respectively. In the current year, after some time in practice as an orthopedic surgeon, Alice, who is often called upon to give medical testimony in malpractice suits, decided to go to law school so as to better understand this aspect of her medical practice. Are Alice's expenses deductible? The answer to that is no. Alice cannot deduct her expenses in going to law school because that qualifies her for a new trade or business. So she is not carrying on a business as a lawyer. Therefore, no deduction. Barbara enrolled in a course of postgraduate study in orthodontics, intending to restrict her dental practice to that specialty in the future. Can Barbara deduct her expenses? Well, the answer to that is yes. Barbara can deduct her expenses of postgraduate study in orthodontics, because in accordance with Revenue Ruling 74-78, these expenses improve her skills as a dentist, a profession she is already carrying on. Kathy enrolled part-time in law school with eventual prospects of attaining a degree, so as to better perform her accounting duties in areas in which law and accounting tend to overlap. May Kathy deduct her expenses? Well, the answer is no, for basically the same reason that Alice could not deduct hers. A law degree will qualify Kathy to engage in a business she could not have engaged in before, even though there is some overlap between being a CPA and being an attorney. This is true regardless of her intent and regardless of whether these expenses improved or maintained the skills of her present employment. Now, perhaps they might be deductible if she was merely auditing the law courses and was not a candidate for a degree, and those audited courses could not be applied toward a degree. Take a look at Reg Section 1.162-5B as in boy 3, example 1 and 2. Denise took a leave of absence from her law firm to engage in an LLM course in taxation, intending to practice exclusively in the tax area. May she deduct her expenses? Well, Denise presents more of a problem. First, the service says that if you go straight into an LLM program after you graduate from law school, you may not deduct those expenses, because then you would have a Morton Frank problem. You would not be carrying on that trade or business. If she has been practicing for a while, though, the question is whether this would qualify her for a new trade or business. So if separate licenses are required, which they may be in some states, generally they're not for a practicing tax attorney, but they are, for example, for a licensed practical nurse versus a registered nurse, so an LPN versus an RN. In that case, if separate licenses are required, the deduction may be denied. Otherwise, if you've been practicing in the tax area and you go get an LLM, you should be able to deduct your expenses. Now, continuing that, in question 2, assume Denise's expenses in problem 1 are deductible. If she's a practitioner in Seattle, Washington, who travels to Gainesville, Florida for a year to participate in their LLM program, what expenses, in addition to tuition and books, may she deduct? Well, so our first question here, remember we have to satisfy the 162 threshold requirements. So the question here is whether she's going to be considered away from home for tax purposes. The sub-question is, to what extent are duplicate expenses required if she does not maintain a residence back in Seattle? If she's able to deduct her expenses, she can deduct the cost of transportation, lodging, 50% of the cost of her meals, as well as her tuition, books, and materials. If she is not considered away from home, she cannot deduct her lodging or meal expenses. Note that most LLM programs run a period of 9 months, and so therefore it would be considered temporary. In 3, Carl earned a bachelor's degree in education, and he teaches world history in a junior high school. In the current year, he contemplates a summer European tour, doing things that will be beneficial to his teaching efforts. He wants to know if he may deduct his expenses. What would you advise him? Well, you should advise him that he may not deduct those expenses. Section 274M2 denies a deduction for travel as a form of education. Note that this section does not preclude a deduction for travel to obtain an education that otherwise would be deductible. In 4, a self-employed dentist attends a 5-day dental seminar at a ski resort. All of the seminar proceedings are taped, and dentist skis on the clear days, watches the tapes on the snowy days, or in other off-the-slopes time prior to his return home. Are dentist travel, meals, and lodging deductible? Well, the conference report of the 1986 Act with respect to Section 274 expresses concern over this situation and regards the costs as being essential for vacation, recreation, or other personal purposes. So therefore, no deduction is allowed. If the convention involves costs that otherwise would be deductible, they remain deductible, even though the videotapes or DVDs may be used where the participants attend a session in person to view these DVDs. This provision also does not disallow the cost of purchasing or renting business-related video DVDs to view. So to be able to deduct the cost of attending a seminar, you must participate in meetings, discussions, workshops, lectures, or exhibits held during the day. Usually these types of meetings have a sign-in sheet to note your attendance at that meeting, workshop, lecture, etc. Our next section on page 390 deals with business losses. Now, losses are the opposite of gains. Remember, gains are defined under section 1001 as the excess of the amount realized over the adjusted basis. Well, losses also are defined under that section as the excess of the adjusted basis over the amount realized. In order to take a loss, you must first have a realized loss. So just like with gains, there must be some taxable event that causes you to realize the loss, such as a sale, exchange, abandonment, or other disposition. Then you must have some provision that authorizes the loss deduction. Now, the general catch-all provision is section 165. We talked about 165 earlier when we discussed 195. Section 165C1 allows a deduction for a loss incurred in a trade or business. 165C2 allows a deduction for a loss incurred in any transaction entered into for profit, though not connected with a trade or business. And 165C1 allows a loss incurred in connection with a casualty, defined as fire, storm, shipwreck, other casualty, and theft, that is not connected with a trade or business or a transaction entered into for profit. So if you have a casualty loss incurred on trade or business or transaction entered into for profit, you look to sections 165C1 and 165C2. The Tax Cut and Jobs Act of 2017 has placed severe limitations on an individual's ability to deduct casualty losses. They're only deductible first to the extent that each casualty exceeds $500. And second, to the extent that they exceed personal casualty gains, and then only to the extent that the net loss exceeds 10% of adjusted gross income. So our bottom line here is that casualty losses for individuals are no longer deductible as they used to be. Instead, it's going to have to be basically a catastrophic loss that would allow a deduction. Let's take a look at the problems on pages 392 to 393. Taxpayer has an automobile used exclusively in taxpayer's business, which was purchased for $40,000, and as a result of depreciation deductions, has an adjusted basis of $22,000. When the automobile was worth $30,000, it was totally destroyed in an accident, and taxpayer received $15,000 of insurance proceeds. What is taxpayer's deductible loss under section 165? Well, taxpayer's deductible loss, and since this is used in business, it would be under 165A1, is $7,000. Taxpayer's loss is limited to her investment in the automobile. She purchased that automobile for $40,000, but she has taken $18,000 of depreciation deductions on it because it was used for business purposes. Since she has been partially compensated by insurance, she does not have a loss to that extent. So her deductible loss is $7,000. What result in A if the automobile had not been totally destroyed but was worth $10,000 after the accident? Well, if the automobile is only partially destroyed and was worth $10,000 after the accident, then the taxpayer's section 165A1 loss, as modified by 165C1 as a result of the regs, under section 1.165-7B as in boy 1 would be $20,000. That would be the lesser of $20,000, which is the change in the fair market value of the property. That is $30,000 was the fair market value before, less $10,000 after, or $22,000, which is the adjusted basis of the property. So that $20,000 amount would be reduced by the insurance recovery of $15,000, resulting in a $5,000 currently deductible loss. So the regulation effectively limits T's potential loss to the actual amount of the loss incurred, further reduced by the insurance proceeds. In C, what is taxpayer's adjusted basis in the automobile if taxpayer incurs $17,000 in fixing up the automobile? Well, taxpayer's adjusted basis in the automobile after the accident and the insurance recovery would be $2,000. That is her initial $22,000 basis less her $15,000 insurance recovery less the $5,000 deductible loss that she would be able to take. And that adjusted basis would be increased by her investment in the automobile, or the $17,000. That would raise her basis to $19,000 as a result of that $17,000 expenditure. The capitalization regulations require the $17,000 expenditure to be treated as a restoration, that is an improvement to the automobile. These are under the regs at 1.263A-3K1, 3 little i's, and 7, example 3. Now, the last section here on page 393 is qualified business income tax deduction. The Tax Cut and Jobs Act of 2017 enacted a new provision, which is section 199A. Now, this is a complicated provision, and it is intended to provide parity between corporations whose income tax rate was reduced from 35% to 21%, with dividends being taxed at 15% or 20%, depending on the income of the recipient. Parity between those corporations and businesses operated as sole proprietorships, partnerships, LLCs, or S corporations, whose income would be taxed at the rate of the individual owners, which could sometimes be as high as 37%. So that 16% difference between the tax rates on corporate income and the business income of individuals was simply indefensible. So Congress enacted Section 199A to provide some parity, that is, fairness, between the two types of taxpayers. Section 199A permits a deduction of up to 20% of what is called qualified business income, which basically does not include investment income or income earned as an employee. So 199A reduces the tax rates on business income of individuals and pass-through entities. It was essentially a bone that Congress threw to individual taxpayers to compensate for the big giveaway to corporations. As I mentioned earlier, we're going to skip the remainder of this chapter. It deals with depreciation. We've talked in very general terms about depreciation. This section, which gets more into the weeds of depreciation, we will talk about in the timing concepts course, in case you were able to take that. We're going to skip over to chapter 15 for our next class, and we're going to talk about deductions for non-business activities. So your assignment for the next class is to read pages 433 to 464 and look at the problems on 454 and 464 to 465. See you in the next class. Stay strong, stay safe, stay well.